A life insurance company makes their profit based on the fact that people are spending money on life insurance policies. When you sign on the dotted line, think of them as a business partner. The life insurance company is going to create a profit based on profit and sales of all these other products. If you become critically, chronically, or terminally ill, you have the ability to accelerate the death benefit and receive a portion of that death benefit completely tax-free while you're alive. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and in this video, we're going to be talking about 10 facts of whole life insurance that I think everybody needs to understand before getting in and making a buying decision. As you know, if you watch my channel, I'm a huge believer in utilizing a portfolio of life insurance products. As much as I love whole life insurance, I don't think it's always the best place to start for a lot of people. There are a lot of people out there that are selling infinite banking, that are selling whole life insurance as this one-size-fits-all kind of product that's going to solve all your financial needs, and it's a secret tool of the wealthy and all this stuff. And I'm going to tell you that it's not. And I'm going to tell you, even though I don't think it's this secret tool and it's this one-size-fits-all product, I will tell you that I love it. And I think it's one of the most versatile assets, and I think everybody should get involved with at some point in their life. I think you should make it a part of your personal financial world at some point. But the question is when. And so I think by the time we get to the end of this video and you understand the facts of whole life insurance, how it works, the good, the bad, the ugly, the traps, the mistakes that people make, I think it's going to help you come to a conclusion that's going to allow you to make the best educated decision for you. Because at the end of the day, that's what it comes down to, is never putting your money into anything that you do not understand. And that's really what it's about. So hopefully by the end of this video, you will have more clarity around that. So if you find value in this video, I'll ask you before we start, just make sure you subscribe and hit the bell. That way you're notified every time I launch a video like this, because I got videos like this literally coming out almost every single day. And they're really focused. I don't think there's another place on the internet where you're going to be able to find more free educational, deep educational video on personal finance and life insurance as an asset to help you accomplish your financial goals. So without further ado, let's get into it. All right, so the first fact that I want to talk about with whole life insurance is the fact that it's a fixed product. Now, there are a lot of different types of fixed products in the financial space. Indexed universal life and whole life insurance actually both kind of are considered under the umbrella of fixed products. Indexed annuities are fixed products. If you get anybody that has a life insurance license, that means they're licensed to sell fixed products. Usually, fixed products are products that will give a guarantee of some nature. There's not a lot of variables. They're not selling a lot of risk in markets that, like mutual funds and equities and stuff like that, where you can actually lose a lot of money. And that's where a lot of speculation is coming, and a lot of criticism is coming to the index universal life markets, because there's actually more risk than other fixed market products, and they're trying to sell them as if there's not that additional risk, and that's one of the challenges. But with whole life insurance, I think it's important to understand, because it's a fixed product, you have a fixed premium, and that fixed premium is good and bad, right? Because the fixed premium means as long as you pay your premium, that is a contract with the insurance company. And that contract means the life insurance company, when you sign on the dotted line, think of them as a business partner. When you sign on the dotted line with a participating mutually held life insurance company, what's happening is you are the beneficiary of that contract, right? So you sign on the dotted line, that means from that point forward, as long as you make your premium payments, the life insurance company is obligated to meet their obligations to you and to the contract, right? And so from that perspective, you are partnering with the life insurance company because you are basically the shareholder. That's why you want to work with a participating mutually held company, not just a mutual company. A lot of companies out there do sell whole life insurance that are mutual companies, State Farm, Allstate, companies like that. They're not participating mutual companies, so you don't participate with this high of a dividend in those companies, and then you don't have the ability to design the flexibilities in that we're talking about when utilizing these policies in the way that we need to structure them and use them in your life. So fact number one, just kind of do a review, is that it's a fixed product, and as long as you pay your premium, that policy is always going to be in place. Now, that also leads us into fact number two, that whole life insurance, even though it's a fixed premium, is more flexible than most people realize. Because here's the deal. A lot of times people rip on whole life for its rigidity. They think that because of the fact that it's a fixed premium, that you're stuck with that premium. Well, if you design the policy properly, you can actually have a lot of flexibility in that premium. So for instance, if I have a policy and I do a 40-60 blend, like 40% base, 60% paid up additions, and I utilize a term rider to allow me to inject more cash value into the policy early, that allows me to have some flexibility in my premium payments, because the 40% is going to be required, but the 60% is not going to be required on an annual basis. So what does that mean? That means if I have a premium of $20,000 and it's a 40% base and 60% paid up additions, that means $8,000 is the base and $12,000 is the paid up additions. So if I have $12,000 in paid up additions, that $12,000 I don't have to pay every year. Typically speaking, there's like a $120 annual paid up additions rider fee. And so my minimum payment, to keep it really simple, would be about $8,120, the $8,000 base plus a $120 rider fee. And this is, depending on the flexibility that you need, this is where company selection comes into play. And you need to make sure that you pick the companies that will provide that flexibility, because to be straightforward, not every company allows you to have the flexibility to just cut out that $12,000 and then pay it back the next year, or like keep funding it at the extra $12,000 with the full $20,000 premium the next year. There's some companies that if you're not able to make that payment one year, you're able to make up for the payment the next year. So in this instance, if I had a $20,000 premium and $12,000 was paid up additions, let's say one year I didn't need to make that premium, or I couldn't make that premium payment, I would just pay the $8,000, right? And then the next year, I could actually pay the full $20,000 plus the $12,000 that I missed the year before, and I could make up for that premium, right? So not every company will allow you to do that. That's why, based on where you are, what your needs are, what your cash flow is, how predictable that cash flow is, you have to always look. There's never a free lunch in the insurance business. There's always a cost and a give and a take to everything. But that cost always comes with a value. And so you have to understand, what do you need the policy to be able to provide you with, as far as guarantees, as far as flexibilities, as far as upsides, as far as loan provisions, as far as all these things go. But the flexibility, even though it's a fixed premium, like we talked about in number one, number two, it's more flexible than you realize. So fact number three is that it has a cash value component to it. So now we're talking about this thing. As we talked about fact number two, we have a base premium and we have paid up additions as part of the premium. Both of those things, both of those elements are going to lead towards accumulating cash. Now, the higher your base premium, the slower it's going to be on the cash accumulation department. People like Dave Ramsey and Susie Orman love to hate whole life insurance because of the fact that if you do 100% base policy, it's going to take 12 to 15 years for you to start having any significant cash accumulation in your policy. Whereas if you are doing the kind of policy blends that we talk about and that we coach people to and sell to people and help people implement in their lives to make their real estate portfolios better, to make have a better emergency fund, to have a better volatility buffer in retirement, to do as a capital reserve fund for their businesses, these sorts of things, the way that we do them, this is where we're talking about being able to have a higher early cash value and having cash liquidity for different use cases in your life, right? So having that cash value component is absolutely huge. But once again, not every company is the same. Not every design of the policy is the same. So you have to make sure that the company, the design, and the agent you're working with is completely in alignment and understands what your needs, what your values and beliefs are, what your concerns are, and what problems you're trying to solve in your life, right? What needs you actually have, what wants you actually have. They can design it around those. Every single policy should be absolutely customized to you. All right, so fun fact number four is dividends are paid in whole life insurance. Now, the cool part is with these dividends, you can do a lot of different things with them. You can take them as income in retirement. You can use them as paid up additions, which is what we're talking about. And when you do that, you have more liquidity inside of the policy. These dividends, I think one of the coolest part is one of the ways that they're most misrepresented by people like Dave Ramsey is the fact that the dividends are actually paid to you as a return of premium. Now, that sounds bad, right? Because it's like, if they're a return of premium, well then, by definition, that sounds like I'm just paying too much and they're giving me some of my premium back. And so that's a challenge. Now, here's the deal. People like Dave Ramsey and Susie Orman will rail against whole life insurance because they're saying, well, if it's just a return of premium, that means you're paying too much. That's the definition of it, is a return of premium, because that's what enables you to keep the tax benefits, right? If it were any other definition, you wouldn't have the tax benefits of the dividends inside of your whole life insurance policy. Now, here's where it gets great. The return of premium is not the return of premium on your policy. It's the return of premium and the profitability. You're basically a shareholder, the equivalent of a shareholder of a publicly traded company. When you are with a participating mutual company, you are the equivalent of a shareholder with a publicly traded company. So you participate through the dividend based on the overall profitability of that company. A life insurance company makes their profit based on the fact that, people are spending money on life insurance policies, whole life insurance, term life insurance, annuities, other investments through the general fund. The life insurance company is going to create a profit based on profit and sales of all these other products. You are getting a return of premium of the entire book of business that the insurance company has, not just your policy. So if you've ever done the research, 99.1% of the time, term life insurance policies are never paid out. They're one of the most profitable pieces of business. IUL and term life insurance are the most profitable pieces of business for life insurance companies across the board. So when you are a participating policyholder with a whole life policy in a whole life company, with a participating mutually held whole life company, all the other pieces of businesses that they have, the term, the annuities or whatever, when those are more profitable, you are participating in the profit of those, and they pay that to you through a dividend. And so you're participating in the success of the general fund returns by them managing the money and getting good returns, utilizing different bond portfolios and different real estate portfolios and so on and so forth, and also the profitability of their book of business across the board. So I think this dividend getting paid as a return of premium gets positioned a lot of times as a negative. In fact, it's one of the most positive things that you can have, and it gives tax benefits, and you're participating and basically partnering with one of the most successful financial companies in the history of the world, right? We have all these participating mutual companies that we have and that we work with have been doing business and have never missed a dividend payment in over 110 years. Think about that. 110 years consecutive, they've never missed a dividend payment. Some of the companies, 150 years consecutive, right? This is one of those things where we have to realize, like, if I have the ability to partner with a company like that meets their promises and never misses a beat, even in down economies, even in the Great Recession, even in the Great Depression, even in the Civil War, right? Like things of this nature. This is not an investment. This is a place that you want to store capital. It's a banking alternative. That's why we talk about it all the time. And being able to have your money in there with it through and receive a dividend payment that is going to help you in all these economies, in all these different markets where you have liquidity, use, and control of that money. That's the powerful thing. So fun fact number 5 is guarantees matter. Whole life insurance has a guaranteed death benefit. And I think it's really important to understand that guaranteed death benefit matters, because while people talk about the fact that IUL, for instance, is this great tool to accomplish wealth, or like even people that are infinite bankers that say, well, the death benefit doesn't matter, let's just focus on the cash value. I'm going to tell you right now, the death benefit absolutely matters, because the way I look at it is we're able to buy our net worth and build our cash flow. If I compare the two, I could put my money in a high yield savings account earning about 4.5%. I could put my money in a whole life insurance policy that long-term is going to earn about 4.5%. Now, with that, what's the difference? The main difference, I'm going to talk about another difference after as another fact, but the main difference is the death benefit, right? That's it. Let's say I'm saving $10,000 a year, like saving, not investing, but this is what I need in my emergency fund, my opportunity fund, my operations capital for a business, something of that nature, money that I need liquid, that I want there. Now, if I'm saving $10,000 a year into that, the big difference between a savings account and a whole life policy is the death benefit. That's it, right? Because long term, they're going to perform pretty close to equal, right? That's just the way it is. In the short term, the bank account is going to outperform because it doesn't have the insurance costs and fees. But if you have a long-term mindset and you can think 4, 5, 6, 7+ years out, whole life insurance is going to decimate anything a bank account can do. Now, that said, if I were to save $10,000 a year in a bank account, at the end of 10 years, I'd probably have like $120,000 or 110 or 115,000, something like that, right? If I die, right, then whoever are my heirs or business partners in a business or something of that nature, whoever is my beneficiary is going to receive that $110,000, right? Like whatever that money is. If I have that money saved in a whole life policy, I'm going to still have that same $110,000, $115,000, $120,000, and that's great. But if I die, then it's able to self-actualize and create, execute and complete the plan. It's a self-completing plan that's going to make sure that when I die, or if I die, hopefully I don't die, but hopefully, if I were to die 10 years from now, then I'm going to have not just that $110,000 go, but what's going to happen is because we utilize paid up additions, that $110,000 is going to actually transition into, say, being $800,000 or $1 million, depending on how you have the policy structured, how old you are, and some other variables. But there's a multiplication effect. That's why I call it a self-completing plan. That's why I think they're so powerful. We talk about the idea of buying your net worth and building your cash flow. Saving your money is a way that you can go in and actually build cash flow. You save in an opportunity fund and you go to invest. But then what happens is now you go and if something tragic happens, well, you need to make sure that you're covered and that your net worth is covered. So when we say buying your net worth, we're using the death benefit to make sure that if something tragic happens, if I'm not able to actually save and build my cash flow long enough, boom, everything I'm working towards automatically self-completes, right? Versus if I'm just saving in a bank account, which the cash value long-term will be about the same, right? But if in a life insurance policy, I get the equivalent cash value, but boom, I got that self-completion component that helps with my heirs, it helps with my family, it helps with my business partners. To me, it's the biggest no-brainer in the world. Fact number 7, whole life insurance is more flexible. I know we talked about this a little bit earlier, but I'm going to talk about flexibility in a little bit of a different way. One of the challenges is IUL and whole life get compared to each other a lot. A lot of people like to say Index Universal Life is kind of the newer, more improved or enhanced version of whole life insurance, when in fact it's the opposite. It's when you put your money into an IUL contract, you are basically giving complete control to the insurance company. When you put your money in a whole life contract, you have complete control, and the life insurance company is obligated to meet their obligations to you versus the other way around in an IUL, where you have to meet the obligations to the insurance company, but all the terms of the contract, the insurance company has the legal right to change, right? And so that's the power of having whole life instead of IUL. But here's the other thing from a flexibility perspective. You can completely pay up your whole life insurance policy after 7 years. Now, this is great, right? If you pay your policy for 7 years, then after that point in time, you can do things like premium offset, which is basically partial surrenders and using the dividend to pay the premium, which it can be a really, really powerful way to fund and keep living benefits and do all these different things. But the other component to that is you can do what's called a reduced paid up policy. So if you say, hey, I don't need as much death benefit, or the death benefit isn't something I value as much at this point in time because my life has changed, my cash flow has changed. So even if I do value the death benefit, I just don't want to be stuck. I can't meet my obligations. I can't make my premium payment. So anytime after year 7, you have the ability to reduce the death benefit and pay up the policy. Meaning, what does that mean? What does pay up the policy mean? It means no more insurance costs, no more fees for any of that. So now what you have is an actual policy with cash value and death benefit where the dividends will continue to pay inside of it. All the benefits we talked about to this point in time will still be there. It'll continue to grow and compound, and you'll have liquidity, use, and control of that money. And all the fees, all the expenses, all that stuff is paid up. Now, the difference with a whole life policy and an IUL is that you can actually have the whole life insurance policy completely paid up with no more fees. Whereas in an IUL, they do what's called vanishing premiums. Now, vanishing premiums look really good on an illustration, but make no mistake about it, there are absolutely still fees going on in the background of IUL. So with IUL, what's happening is it's not actually permanent insurance. It's an annual renewable term chassis. That is what universal life is, attached with an option strategy to participate in the index. Now what happens is, even with IUL, they say it's more flexible because you can do these vanishing premiums and you don't have to pay the premium every single year. And that does provide a slight bit more flexibility than whole life, even though it's not as much more flexibility as I've kind of talked about to this point in time as people think. The problem is that flexibility comes with cost and risk. And where I grew up, I was taught just because you can doesn't mean you should. And one of the problems with Index Universal Life is the thing that's touted as the greatest thing with this flexibility is what actually causes people to get into more trouble than not. And when people illustrate, when agents illustrate these policies with vanishing premiums after 7 years, 10 years, 15, 20 years, what happens is there are still fees going on in the background. And unless you're an expert, unless you've learned how to dissect the illustrations and they've run the illustrations with income, it's really almost impossible to disseminate and make any sense out of the information. And so I think one of the biggest values is the fact that whole life insurance is so flexible that any time after year 7, you can completely pay up the policy. And one of the things that I talk about, one of my favorite elements of whole life, is the control factor, the control that it gives us with our money, the control it enables us to have to be able to accomplish our financial goals, and being able to pay up and control our insurance costs on a guaranteed basis where I'm in control of that, not the insurance company, is a huge factor in why I love it so much. And being able to do that at any point in time during the contract, even though most of the time I wouldn't advise it as an ideal situation, paying it up. And I've got a lot of reasons. I've got other videos on that, so make sure you subscribe and hit the bell. That way you get notified when they come out. Even though I got those other videos and we talk about that all the time, just know that it's an option, even though it's not advisable most of the time. It is an option to pay up the policy. All right, so fact number 8 about whole life insurance is the fact that it comes with living benefits. All the other things that I've talked about to this point in time are great. I just talked about the benefits of the death benefit, the cash value being equal to a savings account, or even better than a savings account from a long-term perspective, but having the death benefit above and beyond that, and that's great. But now, on top of just the death benefit, we have what's called living benefits, the accelerated benefit riders that come on the chassis of a whole life insurance product are amazing. If you become critically, chronically, or terminally ill, you have the ability to accelerate the death benefit and receive a portion of that death benefit completely tax-free while you're alive. Now, here's the beautiful part about this. I share this story all the time. My father-in-law diagnosed with stage 4 pancreatic cancer, which, if you know anything about cancer, pancreatic is basically, the killer of killers of all cancers. By the time he was diagnosed with it, they gave him 90 days to live. They found a 7.5 centimeter tumor on his pancreas that had spread to his liver. It was really not a good situation. The oncologist said, hey, we may be able to extend his life, but the quality of life is not going to be very good, so on and so forth. Because of the fact that, we had access to capital, because of the fact, that we have these things and the ability to access a death benefit, to be able to access multiple 6 figures while he was alive and be able to do these alternative treatments. I'll tell you right now, almost 4 years later, he's still alive playing golf 4 days a week. And he's on his way down to take a trip down to the Dominican Republic and see his grandkids and all these things. And if we followed medical treatment the way that we were suggested, it's almost certain that he'd be dead, right? And so this is taking control of your medical directive and kind of beating the medical cartel, if you will, in the way that puts us more in control. When I talk about the control elements of life insurance, this is one of the things. It doesn't just give us control of our money, it gives us control of the decisions that we make in life. The death benefit is a thing, and it's valuable, and it allows you to control what happens to your money after you die, but it also gives you the ability to control your money while you're alive and offer additional flexibilities to not just pay a death benefit when you die, but help you stay alive. And to me, that's a huge thing. So here's how the accelerated benefit riders work. If you become critically, chronically, or terminally ill, every company is a little bit different. Once again, this goes back to what I was talking about with the way that different paid up additions riders work and the flexibilities and so on and so forth. Depending on what you're looking for and how important the living benefits are to you is going to go into your selection for company. Different companies have different accelerated benefit riders. They have different terms on how those riders work. And so it's important for you to understand all of the variables in different, use cases, right? So typically speaking, if you are diagnosed with a terminal illness within either 12 or 24 months, depending on the company, they will accelerate a portion of the death benefit to allow you to use for whatever you want. You don't have to qualify or quantify what you're using the money for. I've had clients in the past just kind of give up. And, actually it was ironically a case with pancreatic cancer about a decade ago. And she decided to not try to fight it. She decided that she was going to take that money and she was going to actually just take her family on a vacation and enjoy the last couple months of her life. That's a thing. But if you basically get diagnosed with a terminal illness, or you lose 2 of 6 activities of daily living, or become cognitively impaired, you can typically accelerate the death benefit. And by accelerating the death benefit, it gives you a lot more power and flexibility to control your medical directive in retirement. And the other powerful thing to that is most people in America, when we're talking about financial issues in retirement, what we're talking about is a situation where 70% of bankruptcies in retirement happen because of medical issues. And so the cool part is, I think, having this product, having this asset there as a backstop to protect you. It's not just about making sure your death benefit is there. It's not just making sure the accelerated benefit riders are there to help keep you alive, but it also can help give you more financial stability on the back end of everything to prevent medical bankruptcies, to prevent having medical issues, which are much higher likely while you're in retirement, prevent those from creating havoc and wreaking havoc on the rest of your retirement plan. All right, so fact number 9 about whole life insurance is the fact that it comes with a ton of tax benefits. Whether we're talking about the tax-free death benefit that's going to get paid to your heirs, whether we're talking about the tax deferred growth of the policy and the tax-free access through policy loans, you can leverage the tax-free nature of a lot of the provisions in a whole life insurance policy in a way that most people don't even realize is possible. One of the things I talk to people about all the time is one of the biggest mistakes people make when it comes to taxation and our money is most people are thinking about taxes and they talk about taxes as far as tax deferral, right? They think about they're trying to avoid taxes, but they're not really getting a tax deduction. They're getting a tax deferral. When we talk about qualified plans like 401ks, 457s, 403bs, stuff of that nature, it's really just a tax deferral. So if you look at the world around us and we look at the national debt, we look at the government debt, we look at the unfunded liabilities, we look at the interest rate environment, we look at inflation, we look at all these things, every indicator is showing that taxes have to go up. We're in the lowest tax rate environment that we've seen in the United States in a long time, and it's been that way for a long time. And so it's almost inevitable that something's got to give and taxes have to go up. So why take a tax deferral today, right, and avoid paying taxes and then have to pay more in taxes later? To me, that makes no sense, right? So while a lot of people just have a hard time stomaching the fact that they're having to pay taxes, at the end of the day, you're not getting out of paying taxes. You're going to have to pay taxes. So I encourage everybody to think about not worrying about taxes on a year-to-year basis. Think about taxes and your lifetime tax liability, and then realize how you can utilize an asset like this to mitigate and reduce your lifetime tax liability and make sure your financial strategy around taxes is in alignment with your values and beliefs as far as what you believe the direction of this country to be going. And the final fact that I'd like to share about whole life insurance, fact number 10 right now, is the fact that it comes with other riders that you can attach to the policy. There's a plethora of them. I'm not going to go through them all, but everything from guaranteed insurability riders, meaning in the future, if you decide you want to tap on more insurance, you have the ability to do so on a guaranteed basis. This is great in case your health starts to waver in your elder years or whatever. You have the ability to add that on at certain periods of time in your life, at certain benchmarks of your life. You have waiver of premium riders, which will help you pay your premium if anything happens to you. You become disabled, you're unable to pay your premium payment, things of that nature. There's a lot of different types of riders that you can add on. Every company kind of has their own thing. There are even kind of like long-term care riders that you can add to policies. These kinds of things are really important to understand. At the end of the day, there is no one right way to do any of this stuff. And knowing how the products work, knowing all the riders, knowing how to structure them, knowing the problems that you're looking to solve, and then designing the policy and utilizing the riders and understanding the good, the bad, the ugly that goes with all of it, right? Like that's going to be how you actually make an informed decision. And I think what I'd like to end with is just by saying whole life insurance has kind of a bad rap in the industry. And it's got a bad rap for a reason, because most people don't understand what they're doing with whole life insurance, and that includes the agents that are selling it. So what I think is important is that you make an educated decision, that you take the time, you're here, you're watching this video, you do your due diligence, and you actually get to understand what you're doing. You get clarity around what your challenges are, what problems you're looking to solve. And I encourage you to think long-term about the problems you're looking to solve. Because if you're like me and you're 40, I'm 44, I have to be thinking 20, 30, 40 years out, right? Because at the end of the day, this is a product that's gonna help me on the short term, but it's also gonna create benefits for me 30 years from now, that if I don't deal with that right now, the costs of those benefits that whole life will provide me, if I don't deal with it right now, the cost of those benefits that I will ignore will be catastrophic to my personal finances and can actually decimate my retirement plan. And so I just encourage you to think long-term, and I encourage you to, continue the journey, subscribe to the channel, hit the bell, that way you're notified, because this is important stuff. I can't think of anything that's more important than your personal finances than making sure that you get a properly designed whole life insurance policy at some point in time into your life. Like I said at the beginning, it may be you got to start with a term policy. We can evolve into a whole life insurance policy, but hopefully these 10 facts of whole life insurance have helped you evolve your perspective about whole life insurance, what it is, the flexibility of it, what it can do for you in your life, the problems that it can help you solve. And if you have any questions, feel free to reach out, go down below. You can set up a call with one of the agents on my team, set up a clarity call. And if you have any questions, any comments, leave them in the comment section below. I do my best to engage and respond to every single comment that I see. And so if you do that, I promise you I will do my best to engage with you, answer your questions, and even possibly make a video response to it. So that is it for now. Till next time, have a blessed and inspirational day. We'll talk soon. See ya.